welcome to the State of Michigan Investment Board meeting on December 10th. Thank you all for joining. I think we will go ahead and go through the roll call. I will just say, I think if we're, the conversation Robert and I were just having about Act 228 of 2020, as we are relying on the Act to be able to meet electronically as opposed to, our normal Open Meetings Act requirement in person. So part of that requirement, as we're going through roll call, you have to identify your location. So, if you just want to say your city and state as we're going through the roll, that should satisfy that requirement. I will turn it over to Janet for the roll.
Good morning. I will take attendance from quorum. If you could please state here or present. Chairman Treasurer Rachel Eubanks.
So present from East Lansing, Michigan.
Thank you. Mr. Chris Kobe.
Here in Ann Arbor, Michigan.
Thank you. Ms. Stina Richard.
Present, calling in from Naples, Florida.
Lucky. Mr. Reggie Sanders.
Present, calling from Portage.
I'm sorry, could you please repeat that?
Present, calling from Portage.
Okay, if you're not speaking, if you would please put your microphones on mute, that will very much help some of that background noise and echo and allow us to hear each other more clearly. Thank you.
And Mr. James Nicholson.
Present, calling from Detroit, Michigan.
Thank you very much. We do have quorum. We may proceed.
Excellent. Those quick tips are really helpful. If you can stay on mute, except for when you are speaking. And then I would ask my fellow board members that when you're making comments or motions, I don't know that we have any voting items here today, so motion won't be necessary except for the minutes. But if you would identify yourself, that will greatly help with both the public's participation, knowing who's speaking, as well as for minute taking in this electronic environment. So much appreciated. With that, let's see. The first item up is the approval of the September 10th mid-meeting minutes. Those have been circulated. Is there a motion to approve those as presented?
So moved by Board Member Chris Kobe.
Second by Dina Richard.
Thank you. Cold motion and a Richard second. Thank you very much. All those in favor signify by saying aye. Aye.
Aye.
Aye.
Any opposed? The meeting minutes are approved. All right, so I will turn it over to, I think Robert and Greg are going to tag team the executive summary and performance section today.
Yes, great. Thank you, Rachel, and good morning, everyone. We've got a great agenda for you today. We're going to kind of a special treat, deep dive into sort of that other pension fund that we have responsibility for at the Bureau of Investments, namely the Defined Contribution Program. And reason that's more and more important now is we hit a high water mark in the state's DC assets just in October, where we broke through and now have over $10 billion in assets under management. Just those are all participant funds, under the umbrella of the investment lineup that our team in close partnership with the Office of Retirement Services, has responsibility for investment oversight. So that's pretty impressive. And that's only going to grow more and more as more and more participants, avail themselves of the defined contribution as an option. To sort of set the background on this and why this asset class or asset group is growing so much, back in 1998, the state passed laws that changed the participation in what was historically just a pure defined benefit for state employees. And what it did at that time is state employees and state judges, two of the four main plans that we have responsibility for, they were frozen. And what that meant is anyone hired after that date as a new employee, automatically went into a defined contribution plan. So they were no longer participating in the defined benefit plan. And in the 2000s, legislation through various efforts, changed the larger pension fund that we have responsibility for, the MIPSERS plan, as well as the state police, and effectively made them hybrid plans, where new hires are now one half of a defined benefit, and the other half is a defined contribution. So collectively, you've got more and more people investing, out of necessity into defined contribution assets. So that's where our focus will be today, and we're going to have a great presentation from Woody Tyler and his team. He has a 3-person team that oversees these assets and keeps a close watch on the fees, particularly, and the investment performance for each of those options available to participants. With that said, I'm going to briefly start on performance, and then I'll turn it over to Greg to do a deeper dive on performance and asset allocation. So, Lori, if you could go to that page 1 of the executive summary. There we go. Thank you. So you'll see at the top there our performance over various time periods. I want to particularly highlight, the longer time periods, which is where and any pension fund for that matter should focus. And you'll see that over the 3, 5, 7, and 10 years, our returns relative to peer median returns is appreciably higher than those peers. And it's also appreciably higher than our assumed rate of return, which is around the 6.7, 6.8% assumed rate of return. And that, to put that in a little better context, over a long time period, since 1979, our return on the overall pension funds has averaged approximately 9.3%, which is just astounding when you think about, since that time period, you've had multiple recessions, multiple market bubbles, high volatility periods, and market disruptions. So to be able to maintain a overall return since that time period, we're very proud of that. And that's all due to the investment team we have on staff, which has been with us for decades and brings a lot of experience. To equate that in dollar amounts, that over just the last 10 years, it's much more than that when you look beyond 10. But over the last 10 years, just being able to perform above an average performing pension fund, which, by the way, being average for a pension fund isn't a bad place to be. There's a lot of smart people out there across the country investing pension fund assets. And to be average is pretty impressive in and itself. But whenever you can consistently, over a long time period, exceed that, and exceed it by a dramatic amount, that compounds. And to the tune of over $12 billion is what our team's been able to add to the state's pension funds, just over and above that amount. And to put it in another context, of all the retirement checks that go out to retirees every year, 70 cents of every dollar that's paid to a retiree in the state of Michigan, is derived from the investment earnings of our team. That's 3/4 of the monies that a retiree receives comes from our investment earnings. So that's a pretty astounding way to look at it. And when I saw that figure, and thanks to the Office of Retirement Services for coming up with that calculation, that really sends it home for us as to how much pride we take in our jobs and the great work our team has done. So with that, setting that stage, unless there are any questions, I can turn it over to Greg now to dive deeper. Okay, Greg, I'll turn it over to you then.
So Greg, if you are dialed, then you may have to press *6. Everyone was muted when they came in. Okay,
yep.
There you go.
Can you hear me? Okay, yep.
Yeah, we can now.
I had a little panic moment there, and then I remembered the *6. Thank you, Robert, and thank you, Rachel, for the advice. So, Lori, if you would please turn it to page 2 of the performance section. I think that's slide 11 of the PDF. This is our normal when it shows. Yeah, there. Thank you. So this is our report card, right? And I'm sorry. Can you go back one more? Yeah, thank you. So this is our report card. This is how we think about how we're doing as our investment results. And Laura, can you put it back one more page, please? On page 2 of the performance. I think it's on slide 11. Thank you. So it's easy to think of these maybe from an outsider perspective. These are just numbers on a page. And I'd like to, just for a few minutes today, try to bring these numbers to life a little bit. And not only bring them to life, but what are we doing, or how do we think about how these numbers might look into the future? And so when I think about, when I look at what we were talking about a year ago, it seems like a lifetime ago, but a year ago, we had been talking about the probability or possibility for an economic recession in the United States. We were talking about the yield curve inverting, and then it corrected itself a little bit with some action by the Fed. And a year ago, in our December SMID meeting, we had noted some economic weakness globally. The PMIs, the Purchasing Manager Index, globally was showing some contraction. And we had noted some signs of stretched valuations in certain risk assets. And then the pandemic hit. If I think back to March, we were just on the shoreline watching this pandemic storm roll in. And we knew at the time that things were changing, but I don't think we knew at the time by how much and how severe the impact, not only from a health crisis, but also from an economic and social, and just all the problems associated with the pandemic. In June, we noted the severity of the capital market corrections, specifically in public market risk assets. And we also noted at the time the awesome response by the federal government and by the Federal Reserve. And we had wondered at the time whether the worst was behind us and we could begin to build. By September, we had noted that it looked like the worst was behind us, and we noted some improvement in capital markets and risk assets, and also the economy. And now today, we can observe all-time highs in U.S. equity markets. We can observe tightness in credit spreads. And actually, we can go beyond that. There is a euphoria in some segments of the equity markets where some companies, for example, yesterday DoorDash IPO'd, and it's a very, it was a speculative type company, and it was very well received by the market. There are funds, the acronym for these funds, SPAC, S-P-A-C, and they are created for the purpose of making strategic acquisitions, right? And the business model is basically give smart people lots of money, and they will make a smart decision. And so there's a euphoria within the public market, and yet at the same time, the economy is nowhere near healed. The pandemic, as far as a health problem, is still very much with us, and there's hope with the vaccine on the horizon, and maybe hitting our shores as we speak. But you can't help but differentiate between the capital markets and the economy. with respect to the U.S. equity market, thinking about, we've noticed over the past couple of years that there is a group of securities, a group of companies, industries that are really disrupting traditional businesses. And in fact, 2 years ago, in 2018, we had Kathy Wood from ARK Invest to come and talk to our group about some of those themes that her firm has identified as being in the right types of companies and the right types of industries to disrupt the traditional business models. And they were talked about in terms of context of over the next decade. The global pandemic and the responses to that pandemic certainly seem to accelerate many of those trends. Just thinking about this type of meeting, video conferencing certainly was a thing. Zoom certainly was a company, and yet in a span of 12 months, this type of meeting and hosting this types of meetings are becoming more and more common. To put to show, I think, kind of the effect of that type of compression and timeline, if I think about in terms of the NASDAQ 100 as a proxy for those types of companies, and compare that to a broader set of companies, the S&P 500, the NASDAQ 100 year to date is out returning the S&P 500 by over 27%. The investment we have in ARK, as you can see in the materials, has a 1-year return ending September 2020 of over 72%. There are some companies that are doing remarkably well. I wouldn't say because of the global pandemic, but their business models are just really poised to take advantage of the disruption that's been caused. I mentioned the awesome responses of the federal government and the Federal Reserve. And those responses aren't necessarily costless. There's a lot of debt created in those responses, and that calls into question the value of the dollar. It calls into question the fiscal health of the U.S. government. And so with that sort of backdrop, it isn't really surprising that traditional stores of value like gold have increased in value. Year to date, gold is up over 20%. And untraditional stores of value, securities like Bitcoin, it is up 2.5 times year to date. And so you've got this backdrop where there's a lot of disruption, a lot of newness, a lot of things are different now. In the old regime of globalization, it would be easy to think that that's the old way. This is the new way. And yet last year we were talking about economic trade and trade tariffs, for example, and what it may do to globalization. Interestingly, one of the biggest beneficiaries of globalization has been the emerging economies. So emerging markets, for example, have been thought of as a traditional way to exploit the trend, the secular trend of globalization. And so it's interesting, at least for me, that emerging markets have outperformed developed foreign markets year to date as well. They've outperformed, I think, about by a little over 10% year to date, which is again kind of you've got the old way kind of working, the new way kind of working, and so what does that mean? So what does that mean for us in terms of the future for capital markets and asset allocation? We're starting from, we've mentioned this in the past, but important to note. We're starting from a point in terms of return on safe and secure investments, cash, short-term fixed income, treasuries, very low rate. We cannot meet our return objectives investing in very safe securities. We have to take risk in order to earn our rate of return. So in thinking about what risk to take, I just gave an example of what was going on in 2020. The distribution of outcomes is just, I guess in my opinion, much wider. You have the new way, the disruptive companies that are taking share, that are capitalizing, literally capitalizing on in a very challenging economic environment. And the valuations on some of these companies are very high, and they're very speculative. And so they may be thematically great companies, but investment-wise, return on that investment may not be all that great. And yet, it seems like the old system of globalization, there's some hope for return on investment there. Will it continue into the next decade? I think it's tough to tell. The dollar, as a reserve currency, what will its role be? Will other currencies share that stage? Will traditional stores of wealth share that stage? And so it's very, very difficult to think. The range of outcomes are very wide, and it's easy, I think, to make mistakes, and I think it's easy to get it wrong in an environment where we have to be more right than wrong. And so I just want to say today in 2020 that although we've said, maybe we're the little boy that cried wolf, we've said our jobs are becoming tougher and tougher. I feel like today in December 2020, our jobs are going to be very, very difficult to earn the return, just given the backdrop and given the valuations in risk assets, but specifically in safe and secure assets. What does that mean as far as asset allocation? I'm going to make a few observations. The first is that our returns at a plan level are just less exposed to the month-to-month fluctuations of the stock market than they've been historically. And so I think there's some comfort in we don't have to be right on the direction of the stock market from month to month. So that, I think, is helpful. Drilling down, our asset allocation to bonds, both short-term and long-term fixed income, it's about where it was a year ago, at the combined short-term and long-term at 17.1%. Our allocation to equity, if we include domestic equity, international equity, and private equity, again, is about where we were a year ago. We're at 57.6%. And then the balance of the fund, the diversifying assets of real estate, absolute return, and real return, we're at 25.3%. Again, about where we were last year. If we think about where we want to be, our strategic asset allocation, we are a little defensive in the sense that we are overweight those bonds, those short-term and long-term fixed income. We're overweight by about 4.5%. We're slightly overweight equities, domestic equity, international, and private equity by about 1.5%. But we're very much underweight our diversified target weight of by about 6%. It's just really difficult to scale up those assets. It's difficult to find great opportunities. Our team is diligencing opportunities constantly. Our team is, doing the best we can in this environment to meet and speak with management teams to be in front of various industry leaders to get a sense, to underwrite securities there, but even there it's difficult, right? I mean, what does the future for commercial real estate look like, right? We all, in this environment, are learning that certain industries, like financial services, can be done remotely. We can communicate via video conferencing pretty effectively with text and emails and all sorts of technology tools. The transition is pretty seamless, and so what is our today's normal? How much of that will carry forward next year and in 10 years from now? It's tough to tell. And so, again, that just leads me to say that the distribution of outcomes is just going to be, I guess, in my estimation, wider. The potential for those distributions are going to be wider. I guess I'll stop there so we can answer any questions or if there's any different directions you want us to take this conversation.
No, Greg, that's been incredibly interesting, and I think some very interesting reflections of an unusual year. I will open it up to my fellow board members. Any thoughts, comments, questions?
This is Gita Richard. I had a comment and a question really quick. First of all, the comment is really, I appreciate the team's focus and the strong performance that you've been able to generate through the pandemic. And I know you've talked before about maintaining, a level of liquidity to reduce risk and meet benefit obligations. So very well done. And Greg, you mentioned the distribution of outcomes. Does that bode well, when you think about active management that the state employs in the funds?
I sure hope so. I think I think this is the environment. Look, if we're going to add value, this is the environment, and I'm encouraged by the performance that we're getting in real time. It seems that we're more right than wrong, but I think this is the time for active management to show its mettle. And potentially, right now, the actual outcomes will be whatever they are. But I think this is an opportunity for us for sure.
Thank you.
Greg, I had a question. Just in touching on your point about the more tech-related stocks, to what extent have you done any analysis on the attribution of the Bains and Microsoft and the contribution they've had to the benchmark returns of the S&P to kind of capture not only the tech component, but the large cap component of it as well, because, and it's a big part of your benchmarks in the private equity side and on the domestic equity side. And if you haven't been, obviously you won't be in these stocks on the private equity side, but even on the domestic equity side, if you're not as big in these things as the benchmark, you have little chance of keeping up, let alone outperforming. This is something that all allocators have to deal with. So, have you done any attribution on that impact as well? And how do you think about, just trying to counteract that, from an active management standpoint, both on the domestic equity side as well as on the private side?
Okay, yeah. So, one, we haven't done any special analysis on the FANG stocks and their contribution, other than what we received, and others have done, on Wall Street have done analysis. So we obviously are familiar with it, but we haven't done anything beyond that. I will add a couple points, and then Jack, if you want to dive in, that'd be helpful. I'd make a couple points. One, half of our domestic equity exposure is indexed, and so we're going to have exposure to those securities that are in the index. second, when we do attribution on our investment results, the FANG stocks haven't been a problem, meaning the drivers of excess returns, both positive and negative. Jack and I, the conversations that Jack and I have haven't been, hey, Amazon is doing really well, and we're not. So what should we do? Those types of conversations just aren't happening. So it's something that I feel like our risk framework is doing a really good job neutralizing that potential issue. I think where it gets trickier is maybe more on Dina's question, where there may be a greater opportunity to do something more, but it would be adding more risk. And so that's where we have to be more certain. And so, so Jack, I don't know if you have anything to add to that. I think it's a great question, and I think it can uncover a lot of our risk framework and the way that we manage relative risk within the domestic equity portfolio. Again, just to conclude, it hasn't been a problem for us to have to deal with.
Got it. Okay. Yeah, and I would just add that, and I've given a shout out to our growth team sort of many times over the years, but I think it's a problem for most managers. Our growth team has just crushed it. And the amazing thing is they've done it without owning those names, Reggie, if you can believe that. So, ARC doesn't own many of the FANGs. They'll tell you that what they own are sort of the next FANGs, but it's not just ARC. Our internal large cap growth fund, which is the closest to owning some of those funds, has outperformed the growth benchmark by 5% over the past year. I mean, this is really amazing to me because growth has crushed it, and our growth managers have crushed the growth benchmark. And I'll give you another example. Henry just launched a fund in September. You'll remember he presented, and I was really nervous because these stocks have done so well. And my fear was, oh my gosh, okay, we're going to launch a fund at the beginning, at the top of the market, and I want to set him up for success. His fund is up 43% in 2 months, and he doesn't own the FANGs. He's just a great stock picker. And for example, his biggest weight was in a little company called Stitch Fix, which is just a fantastic little company. And so I just give our team a lot of credit. We have another growth fund internal that's also crushed it. And so really just the skill of our growth team has been a tremendous asset that I'm so grateful for in this period. And that's why we're not talking about the FANGs and being reactive.
Got it. Yeah. Thanks for highlighting that, because most institutions don't have that ability to do that.
We're just really fortunate for the team we have.
Yeah. No, that's just to echo that. I think about the issues surrounding 2020. It's the issues that I guess we don't worry about. It's easy to take for granted, but this team at the Bureau of Investments, I can't say it strongly enough just how awesome it is, how we've come together, how we really haven't missed a beat in terms of communication, in terms of idea sharing, the work that I see day in and day out. I know we have something rare, and I know we have something great, and that's what really gets me excited about the potential. And look, if we didn't have this team, and given the backdrop that I just shared with you, a few minutes ago, I would be worried. I mean, I would be really, really worried. But we've got a fighting chance. I like our odds.
Yeah. And I'll just echo some of what Greg has said there. You ask any professional or collegiate level sports team, and it's all about the team, right? And that applies here as well. We're only as good as our people that we're entrusting to invest these assets on our behalf. And we're very fortunate, as Greg and Jack have noted, that we've just got outstanding people working for us and are really dedicated as true fiduciaries over these assets. So just kudos to everyone for that.
Great. Agree on the comments. Is there, Greg, are you, was that concluding your presentation, or did you have anything else to share?
No, I didn't have anything else to share, Rachel. Thank you. And just
okay.
Again, just thankful for the Bureau, thankful for our leadership from top to bottom. Awesome place to work, and I'm looking forward to 2021. I can tell you that.
Aren't we all? Okay. Thank you very much, Greg, for the presentation. Our next item on the agenda is the defined contribution presentations. Woody Tyler will give a presentation, then he'll go ahead and introduce the rest of the presenters. Turn over to Woody.
Thanks, Rachel. Appreciate that, and thank you for that introduction, and very good introduction, by the way, Robert, on that, as you call it, the other retirement plan that we manage and oversee. First of all, can everyone hear me okay?
We can hear you great.
Terrific. Good. While Lori is bringing up the slides, I also work with a terrific team, and it's beyond just the BOI, but as Robert mentioned, I have Lon Chen, who works for me. You'll be hearing from her later. We have Nick Whitman, who works with me. He prepared a lot of these slides, so even though he won't be presenting, you'll see a lot of his work in the slides that we're presenting. And we also work with the Office of Retirement Systems, and just a terrific group of people there, and they'll be presenting later. And we'll have one of our asset managers presenting, State Street Global Advisors, and I'll make an introduction to them a little later. I think everybody knows defined contribution is a little different than defined benefit, or maybe a lot different. We do have sort of an overarching sentence in our presentation booklet that you have that describes the role that we play. And I'll just read that to you, and then we'll kind of delve deeply into what that means. But the Bureau of Investment's role is to work in a consultative capacity with the Office of Retirement Services, and with the approval of this investment board, in making sure there are a sufficient range of investment options which will enable the participants to meet their long-term retirement needs. That's a pretty heavy statement, and we'll get into actually what that means. Lori, if you could go to the next slide, please. So we have 4 parts to this presentation. We have the defined contribution overview. I'll be presenting on that. That goes from version 1.0 to 3.0. We'll talk about where the industry has been, where it is now, and where it is heading. And you'll get an overall theme that really what they're trying to do with defined contribution is make it look a lot like defined benefit. Then we'll have Anthony Estelle and Allison Wardlaw, Allison, from the Office of Retirement Services, presenting on the 4 funds that Robert mentioned and did a very good introduction on in terms of the differences there. ORS oversees both the defined benefit and defined contribution plans for the 4 major plans that we invest for. But each of these plans is a little different, and they'll be kind of delving into that. And also, thanks to their hard work, a lot of what I'll be talking about in terms of the changes that have happened in this industry, they've already implemented, and they've done just a terrific job. So I can't overstate that. Then we'll move to the Michigan DC Plan Investments. Lon Chen, my coworker, will be presenting on that, what we do, how we look at these investments, and our thoughts behind how we constructed the portfolio, and then kind of how we monitor that going forward. And then, as I mentioned, we'll have Mary Guy, Brendan Curran, and David Ireland from State Street Global Advisors present on our target date funds. The target date funds play a very important role in this plan. They're about $2.5 billion. And as Robert mentioned, the plan size at the end of September was just over $10 billion. So 25% of our portfolio is invested in these target date funds. and they're taking over 50% of contributions coming into the plan currently, and that is expected to grow as we move further down the line. Next page, please, Lauren. So DC plan has already supplanted defined benefit, and you can see that in the chart below. And what we have on the x-axis are the various generations. I'll be honest with you, I didn't realize there were some of the names for these generations, such as Depression babies and war babies. But what we're looking at below is the projected income source by generation at age 65. So you see the blue line there is Social Security, which comprises and holds at about a fairly steady rate of about 35% of the contribution. And then the green line you can see is a defined benefit plan. And that is playing a decreasing role as we move along. And as you follow and look below, you can see that red line moving up, that red line, which is retirement accounts. That is becoming more and more 401k, 457 oriented. And with the leading boomers, those baby boomers born between 1946 and 1955, who are retired or retiring currently, we have a crossover point. And so defined contribution surpasses or is beginning to surpass for that generation. And as we look forward for the trailing boomers, those that will be retiring, say, in the next 5 to 10 years, defined contribution will play a more predominant role, and it only increases as we move out to the Gen Xers and millennials. Next slide, please. Thank you. So version 1.0 of the defined contribution plan in the 1980s, they debuted the first 401k plan, and it was viewed initially as being a supplement to the DB plan. Then as we moved into the 1990s, more workers participated, but really not a lot. Only a small percentage were actually putting some of their money away. As we moved into the 2000s, a lot of companies displaced or did away with their defined benefit plans, and governments, as Robert had alluded to earlier, and they moved to defined contribution. As they were doing that, it really revealed a lot of underlying faults with defined contribution. Namely, participants really weren't joining into defined contribution plans. Those who weren't saving enough, or they were not really selecting appropriately diversified investments. Next page, please. You can see really the fault was defined contribution really expected too much from participants in terms of making their investments. And you can see this is done by our friends at State Street. They ran a survey of participants globally within the retirement funds, and they asked, how important do you think having a diverse mix of investments is? How important do you think making asset allocation changes are for your investment? How much do you think you need to save? And the last one there, how important is it making your savings last in retirement and last a lifetime? To the right, you can see how many people they surveyed felt that this was important, and it ranged from 65% to all the way up to 82%. To the right of that, how many people feel they were knowledgeable about that? It's 1/3 or less. So really, the industry was expecting a lot of participants to manage their investments for retirement, and they were really kind of failing in this. And if you look at the next slide, please, Laurie. Thank you. So I think that jumped on me. I'm sorry. Well, you're right. I'm sorry. Behavioral economists actually did a lot of work here. And one of the leading ones was Richard Thaler out of the University of Chicago. They looked at participant behavior and tried to figure out ways that they could help in this issue as we discussed. in their groundbreaking research, really found that defaulting workers into better decisions about both participation, contribution, and investing would significantly improve the expected outcomes. A few years kind of after that initial research, we had in 2006 passage of the Pension Protection Act, which encouraged automatic enrollment. So you started with an organization, you're automatically enrolled into the defined contribution plan. You can opt out, that's an option. What you'll see here is they're taking advantage of a human behavior called inertia. I'm sure we're all familiar with it. But in this way, it works in a positive way in terms of really getting people to do the right thing in defined contribution. The next bullet point below that is automatic escalation of those contributions. So you start maybe at a low contribution rate, and over the years, you build up each time, and so that you're saving more and more for retirement. And then we have default investment options, what we call qualified default investment options. Ours happens to be the target date funds, which we'll delve into a little later. And it's a very diversified portfolio, but I won't jump into that right now. State Street will cover that. Next page, please. Okay. So the important thing is, the autos really are working. If you look over at the right in that upper right chart, the auto enrollment, you can see the participation rate among millennials. With those plans with automatic enrollment have an 85% participation rate. Those plans without it have only a 38% participation rate. Below that, we have auto escalation, and we have that light purple line, which is before auto escalation, and then the darker line indicating what the savings rate was after they implemented auto escalation. You can see before the implementation of auto escalation of savings, 2/3 of participants were saving 6% or less for their retirement. With the implementation of auto escalation, you can see that jump in those dark purple lines to you saw the increase between 7 to 9% jump from 24% to 44%. Then you look at the 10% or more, we have the increase from 10% to 15%. And the best part about this, if you look at that to the left, that kind of aqua color, I guess, I'm not very good with colors and names of colors, but aqua color, I guess, we actually have about 70% of participants who actually approve of this. So it's working. Investors and participants are in favor of it. It's sort of a win-win situation for all. Next slide, please. I won't spend a lot of time on this because State Street will be covering this, but the implementation of sort of an automated investment management is a target date fund. And you'll see this with a low minimum investment. You can really get instant diversification. It is low cost. We use primarily index funds to create this. Professionally managed, so hassle-free investment management. And we have a glide path that takes more risk when people are younger and then decreases that risk as people get closer to retirement. And I won't touch on the chart below simply because State Street has a much better chart than what I have. So I'll leave it to them to cover that part. Next slide, please. So that is sort of where we are in the industry today. That's sort of version 2.0. And what we have in the chart below, you'll see is sort of moving from when you first start and save and all the way through kind of early retirement and into that decumulation phase. We have accumulation, retirement, and then decumulation. And the industry has done a lot to improve the accumulation phase. The retirement phase is a little bit more of a challenge, namely trying to keep people in the plan. But the decumulation phase is the next major challenge that we're facing. Next slide, please. We may have talked about this before. It actually passed at the end, right in December of 1919, what they call the Secure Act. Somewhere in the federal government is a department that creates these acronyms, but setting every community up for retirement. And, this has kind of hit a few of the major benefits of what that set up. It raises the age of required minimum distribution, the RMD, from 70 and a half to 72, increases the automated escalation safe harbor cap from 10% to 15%. And if you look at that last bullet point, new employer protections for offering annuities. And you look below, we have annuities. It essentially is providing safe harbor for plan sponsors that will protect them from liability when selecting an insurer. They kind of set up a criteria in which, if you follow, will provide you that safe harbor. The issue is, and it's the function, I think, of the complexity. Anybody who's talked with annuity providers will know immediately what I'm talking about. We haven't had a lot of uptake of annuities. And again, I think that may be attributable in part due to the complexity of those annuities, but also we are in an extremely low rate environment. So most people look at fixed annuities, and if you look at those, with the low rates we're getting right now, I think there's a little bit of sticker shock in terms of the kind of annuity you're going to get for the amount of money that you have to put up for. Next page, please. Thanks, Lori. When we look at, basically the major risks for participants as they move into and through retirement, two of the major ones are market risk, namely a major market drawdown like we experienced back in March or back in 2008. But the target date fund does a lot to really mitigate that by de-risking the investment portfolio as people get closer to retirement. The biggest one is the longevity risk, in that risk of people outliving, their investments, and how do we deal with that? And actually, we're seeing as people move into retirement, rather than drawing too much down for spending, they're not drawing maybe enough, and so it is an issue. The Secure Act, as we mentioned, does provide some solutions in terms of that safe harbor. It also, that last bullet point down there, requires lifetime income disclosure from DC plans. And something like, if you're in your middle 30s and you have $250,000 saved up, they'll project what that would mean once you retire in terms of income per year going forward. Now, the Department of Labor is working on the numbers that they need to provide people like ourselves for making those calculations. And I believe, and Anthony can maybe touch on this in his presentation, I believe those don't come out until next year in 2021. Next page, please. So like a lot of people in the industry, this is something we're spending a lot of time working on and looking how to meet the needs of our participants in their retirement needs. And you see the quote there at the top of the at the top of the page from William Sharp. This is the nastiest, hardest problem in finance. It's just, it's essentially we have one equation and three unknowns, and we're, how long will people live? What will they earn while they're invested, and how much will they have saved by the time they retire? It's a difficult problem, and we are spending a lot of time on it, like other people in the industry. Right now, there are four main ways to deliver retirement income. We have these managed payout funds, qualified minimum withdrawal benefits, already as part of our fund. Out of plan, we have longevity insurance and annuities, but again, few people are picking that up. And that's where we are. I'm sorry, I apologize. I know I went through quickly a lot of this presentation. Before I hand it off to Anthony and Allison, I'm willing to take any questions I can answer at this time. Hearing none, I'm going to hand the baton off to Anthony and Allison.
Thanks, Woody. Good morning, everyone. Feedback there. As Woody said, my name is Anthony Estelle. I'm the Director of the Office of Retirement Services, and I'm going to be joined with my colleague, Allison Wardlaw, who's our Director of Plan Development and Compliance. And we're going to spend the next few minutes here kind of just giving you an overview of our office, the members we serve, and the plans that we administer. So, Laura, if you want to go ahead and go to the next slide. So this is just our purpose statement, kind of what guides us, similar to what Woody shared from the investment side. This is what we look at from the administration side. And really, there's a couple of points I want to draw out here. It's that successful today and a secure tomorrow. We really try to work with our members and participants to help them strike that balance between what they need to do today to live for today and to save and live tomorrow. Ultimately, retirement is control over the content and pace of your life. That's what we want people to get to. So our work as they move through their careers is to help them build the necessary savings to produce income on the defined contribution side, and then to make the good decisions on the defined benefit side to put them in a place where they can enjoy their retirement in whatever way they do, whether that's traveling, volunteering, watching their grandchildren, picking up a new job, taking up a hobby that they've set aside for years. Lori, can you go to the next slide? So I'll just go through this quickly. This is just a snapshot, and there's a number of elements that are in this slide deck from us that Allison and I have put in here that are just informational for you to have as a resource so that you as board members can better understand the members and participants and plans that kind of sit atop the assets that you help oversee. So this is just a snapshot of really where the plans collectively stand relative to other plans and systems in the country and world. So you can go to the next slide. So we have about 550,000 members, retirees, beneficiaries, and participants. So when you look at that in the state, that's about 1 in 14 Michigan adults and 1 in 9 households who have some relationship with our office. So that's significant reach and impact of what our members and participants do. And if you go ahead and go to the next one, sorry. I apologize. Working from home in 2020, right? So having a strong retirement system is, we feel, is good public policy, promoting the financial security of the members in retirement, because the studies and data have shown that retirees, unfortunately, are one of the highest poverty groups in our country, and especially women in retirement. So these are all areas that we are working very heavily towards to try to help our members and participants have that secure retirement, because when people do not have that financial backdrop of a secure retirement, they end up on the social safety net, which, as we know, is very expensive and not fully funded. Go ahead and go to the next slide, please. So that a couple slides ago talked about, in fiscal year 19, it was about $8 billion that flowed out of for pension and healthcare benefits. Well, that has direct economic impact on the state. The National Institute for Retirement Security does a study every year. They call it their pensionomic study. So this is primarily on the defined benefit side, but they're starting to make plans to also try to incorporate the defined contribution side. But you can see that significant impact that money coming out of the pension trust, coming out of the healthcare trust to support those members and beneficiaries in retirement, and how that supports the state and their surrounding communities, because those monies are typically directly spent. These are not monies that are saved. These individuals are using these to live and act in their community. Or you can go ahead and go to the next slide. And one of the things that we're very proud of is, in terms of our administration, is that we administer these plans, and Allison is going to, in the next few slides, walk you through our members, but we do this in a way that's very low cost, while at the same time continuing to provide high levels of satisfaction to our customers. So there's a group called Cost Effectiveness Management, or just CEM, that benchmarks retirement plans, and as you can see, we are well below the average of peer and median in terms of our costs, but our customer satisfaction scores remain very high. We are very proud of that. So with that, I'm going to turn it over to Allison, and she's going to walk you through the next few slides to talk about our plans and our members.
Great. Thanks, Anthony. I'm hoping you can hear me because I had to join via phone on the audio. So if you can't, please let me know. So ORF offers 3 types of retirement plans: defined benefit plans, defined contribution plans, and hybrid plans. So each of the members in these retirement plans interacts with the DC plans in a different way. Go to the next slide, please. Generally speaking, a DB plan provides a guaranteed lifetime income based on the length of a person's career and their final average salary. So while nearly all of our DB plans are closed to new members, we do still have legacy members who may have a 457 deferred comp account, which will supplement their pension in retirement. Next slide. As I mentioned, all of our DB plans except for the Michigan National Guard are closed to new members and have been since 2010. We still have many new members accruing benefits in these plans, but no new ones are entering it. The DB benefits that we offer are fairly modest compared to those offered in other states. Our average pension amount is just over $23,000. This makes encouraging savings on top of the pension even more important. Most of the cost of paying these pensions comes from investment earnings, as was mentioned earlier, on the pension trust dollars. So you can see in the graphic that of every dollar paid out, 67 cents comes from investment earnings, 26 cents from employer contributions, and 7 cents from contributions made by the member. Next slide. For many of our participants, the DC plans are their only vehicle for retirement savings. So while some of our participants in the various systems receive a subsidized health care benefit in retirement, for others they have a personal health care fund, which is a 401k or 457 account for their health care savings. So it's critical for participants who will need their DC benefit to cover their living expenses and their health care expenses to understand how to save and draw down their benefit. Next slide. So we offer hybrid plans for public school employees as well as Michigan State Police troopers. So these hybrid plans offer a small pension in addition to a small DC component. The first hybrid plan is called Pension Plus and was available to public school employees who started work between 2010 and 2017 and troopers who took the oath of office after June of 2012. So starting in February of 2018, no new public school hires went into this Pension Plus system. Instead, they go into a different hybrid plan called Pension Plus 2, which is even more conservative than the original Pension Plus. So our hybrid plans represent a model where costs and risks are shared fairly equally by the employer and employee. They're cost effective. They're actually a little cheaper for the employer than our defined contribution plan alone. And our hybrid plans are doing well. We have more than 47,000 members enrolled in our hybrid plans, and all hybrid plans are over 100% funded. Next slide. So as an office, ORF handles the ministerial functions of the DB and DC plans, along with the retiree health care administration. The retirement system boards handle the discretionary duties. So we focus on plan administration, contract and vendor management, communication with members, employer relations, and member payments. Next slide. I'm going to talk briefly about our membership because I think it's important to get a glimpse into the variety of people in our plans. So there are a few products or services or communications that are going to be broadly applicable to those 500,000 customers that Anthony mentioned. So I'm going to go through these quickly, but you'll have them in the slide deck for reference. So let's look a little more specifically at MIPSers and the benefits that are provided to public school employees and retirees. So we have over 400,000 members in the system, including active members, retirees, and beneficiaries receiving benefits. A little less than half of these are active members and a little more than half are retirees. It also represents our largest growth area in the DC plans because of all those new hybrid members. Next slide. The plan that someone is eligible for depends primarily on the date they first worked for a Michigan public school, as well as any elections they've made in a reform election window. So generally speaking, those who were hired prior to 2010 are part of a DB plan. Those hired between 2010 and 2012 are part of a hybrid plan. And those who were hired after 2012 had a choice between a hybrid plan or a DC plan. Next slide. So if we look closer at the retiree healthcare, employees who started working for a public school prior to 2012 receive a subsidized retiree healthcare premium. Those between 2008 receive an 80%. Those who started before 2008 receive an 80% subsidy in most cases. Those who started between 2008 and 2012 receive a subsidy based on their career length. And those who started after 2012 participate in the Personal Health Care Fund, which provides an additional 2% employer matching contribution to the state 401k or 457 plans to help members save for their health care expenses in retirement. Next slide. Included here a slide about the state employees retirement system. State employees have been exclusively enrolled in the DC plan since 1997. Next slide. You can see that state employees enrolled in the DC plan in 97 and the Personal Health Care Fund 401k and 457 plans starting in 2012. Next slide. So our state police troopers have a closed DB plan and are now part of the Pension Plus hybrid plan. They have a small pension and a small DC benefit in addition to their Personal Health Care Fund. Next slide. So the Pension Plus plan for state police troopers and the Personal Health Care Fund were both introduced in 2012 for this system. Next slide. For the judges' retirement system, judges in our plans only have a DC retirement benefit today. Next slide. And you can see on this slide, subsidized retiree health care is offered for elected officials, Supreme Court justices, and appellate judges. Next slide. The Michigan National Guard members are part of our only open defined benefit plan. Next slide. And Michigan legislators are part of our defined contribution plan. So as you can see from this overview of our customers, ORF needs to be a service provider in many different ways to many different participants. So each of them have their own retirement goals and plans. At this point, I'm going to turn it back to Anthony to talk a little bit about that complexity.
Thanks, Allison. So I know we're moving up in some of the time, so I'll kind of try to go quickly through these last few slides. So Laura, if you want to go ahead and go up to 37 there, and then keep your finger on the trigger, we'll move quickly through these last few slides. So this is just kind of a snapshot. Several others have talked about the changes and reforms that have happened to the plan. So starting back in 97, the state became the first state to have a public statewide defined contribution plan for the state employees in those groups. So that happened in 97. Things were relatively quiet for about a decade, and then as you can see in the late 2000s, things really picked up with a wide variety of reforms that introduced a number of different plans and options. Mixed in there was also 2 early outs, one for the public schools and one for the state employees. So that introduced a lot of complexity and added administrative challenges for us. So if you would go ahead and go to the next slide. So this is just a snapshot of that complexity. The blue represents the different pension plans, and the green represents the healthcare options. And in most cases, there's some combination, therefore, of healthcare and pension. And you can see very quickly how that turns into quite an array of different options to administer. So go ahead and go to the next slide. So in that, we just wanted to give you a feel for what we do from the administrative side in terms of communicating with both our members and employers, because one of the important things to remember is that in administering these plans, we both handle the benefits for our members, and we have to get the wage and contribution data from the employers. So when you bring all the different employer groups that we interface with, that's nearly 700 employers that we work with on a pay cycle basis, bringing their data in. So this is just informational for you to kind of get a feel for the volume of transactions that go through our office in a month. Go ahead and go to the next slide. So Woody and Robert talked a lot about the partnership with Bureau of Investments. We also all work and partner with our third-party administrator, our record keeper, Voya, to provide both support the investment options that are provided to the DC plans, as well as doing the record keeping and administration of those plans. Woody talked a lot about the automatic programs. I'm going to dive a little bit into the small steps just to give you some highlight of that success. But one thing, though, is that 96% of our participants who have some defined contribution component, which now is every new hire into any of those plans that Allison shared with you, 96% of them are taking full advantage of the employer matching contribution. And that's a very important saving milestone in a defined contribution, because obviously that's free money. That's putting $1 in the jar and getting $1 put in there for you. So that's a very important initial milestone to reach. I'll go ahead and go to the next slide. So our Small Steps program, Woody talked about this a little bit. This is part of our auto enrollment program. Anyone who's a new hire to any of our plans is part of the Small Steps, and each year their contributions will be increased by 1% until they reach 15%. They obviously have the ability to opt out or change that deferral at any time. Or if you would go ahead and go to the next tab. This is just a snapshot of the program that we did last year. Over 100,000 participants were part of the program. And to, again, reinforce the points that Robert and Woody made about the success of these, you can see nearly 93% of the people retained that increase. So 93% of those participants kept that 1%. We have a number of participants who increased even further. And then there's actually a small subset, kind of speaking to Woody's points about inertia, that when they realized that the goal was to get to 15%, they just went in and increased themselves immediately to 15%. We think that's a really remarkable outcome. The next slide, though, or the next couple slides, are really the ones that I want to highlight that are going to show why this is such an important thing. We work with Voya, and they use a tool through Financial Engines to chart the savings, diversification, and income outcomes of our participants in the plan. And so the Small Steps program has a significant effect on two big areas, savings and income. So you can see in the top graph, the Q1 2015, that was before we had Small Steps. So those different savings bars show whether the person in the red is not saving up to the match, a person in the yellow is at least getting in the match, and then the green are people who are saving at the level that the Financial Engines tool says they should be. So you can see now, moving out into 2020, that dramatic 147% increase in people who are at least getting the match, and many more that are moving along that spectrum. But I think the more remarkable number is the second set of graphs, which talk about the income projections. So the goal in the tool is to achieve a 70% of pre-retirement income based on the savings that the individual has. And to achieve a green on this, the person has to have at least a 95% likelihood of replacing 50% of their income in a down market, and a 50% likelihood of meeting this target in an average market. And so you can see we've had a doubling of the number of participants who are achieving that green retirement income outcome, which is ultimately the goal of a defined contribution plan like Woody highlighted earlier. I'll just skip over the next few slides, Lori, so if you just want to go to up to 47 before we turn it over to Lon. So that really is the extent of our presentation. We want to thank you for the opportunity to kind of give you an overview of what we do in the Office of Retirement Services, how we work with Woody and Robert and Greg and all the team over there at the Bureau of Investment to really move the plans forward and try to create the best outcomes we can for the participants. I'll stop there and see if anyone has any questions for Allison and me. All right.
Hey, and I want to check with the board members and Robert. I know we're running sort of over, and is it okay if we extend it by 15 minutes, maybe go 15 minutes after the hour, after 11 o'clock, or do you want us to go through this?
Yeah, I am available 15 minutes, Woody, but I think we probably should try to pick up the pace.
Will do.
Yeah, I'm available for 15 as well. So.
Okay, terrific. Thank you.
Well, with that, I will turn it over to Lan Shen to talk about the investments in the plan.
Thank you, Anthony. In the interest of time, I'll just highlight a few slides that describe our investment options and aggregate allocation across the investments. Lori, could you turn to page 50, please? Defined contribution plans are participant-led. As a plan sponsor, our objective here is really to provide investment options that span the risk-return spectrum. This allows each participant to be able to construct portfolios to meet individual risk tolerances and have the ability to diversify their individual risks. The investment options range from the very conservative stable value and money market options to individual stock options that are exposed to idiosyncratic risk. Next slide, please, Lori. The plans have 19 investment options across 3 tiers. Tier 1 includes the default that Woody mentioned, target date funds, as well as low-cost passively managed funds through State Street and BlackRock index funds. Tier 2 are actively managed funds, which attempt to outperform their respective cash, bond, and stock indices. Tier 3, which includes a self-directed brokerage window, allows participants to choose from a plethora of investments from individual stocks, bonds, and mutual funds. Tier 3 also includes loans that may be taken out by the participant. Next slide, please, Lori. Here, again, Woody mentioned the default, which State Street will spend some time on, but really it's a one-stop do-it-for-you option with professionally managed asset allocation and a glide path that de-risk as the participants approach retirement. Next slide, please. Here we'll just spend a few moments highlighting the aggregate allocation of the options. The bar graph illustrates the market values across the 19 options offered. Tier 1 represented in blue, Tier 2 in red, and then green, Tier 3. As you can see, the standout here is really that target date funds, as Woody mentioned, at 25% of the plan's $10 billion assets. Next slide, please, Lori. Here, although we see growth in target date funds, the majority of the assets are still held at equities, and this is very consistent with industry findings where target date investors are more likely to be younger, lower wage, shorter tenured participants with lower account balances. Yet the majority of the plan assets are held by a longer tenured, older cohort with higher account balances and high allocation to standalone equity options. And from an investment risk perspective, a greater allocation to equities is still appropriate given the long-term retirement objectives of most DC participants. And here we'll conclude with an aggregate allocation over time. The trend is illustrated in the chart, shows the growth of target date fund assets. The bottom blue area plotted across time as target date funds, and the growth really is driven by the policies described by Anthony and Woody of auto enrollment, auto escalation into that default target date fund option. And so with that, I'll open up to questions before handing it over to State Street.
Thank you, Juan. I think we can bring up State Street's presentation. Thank you.
Great. Thank you, Woody. Lori, if you can turn to page 5, please. Very quickly, my name is Mary Guy. I'm the Senior Relationship Manager at SSGA, and I've been working with the state of Michigan since 2003. We have a very long relationship with the Michigan Treasury and ORS on both DD and DC, and we appreciate that greatly. So thank you very much. Page 5, just a quick reminder, who is State Street? We're a Boston-based corporation. State Street Global Advisors, who does all the asset management that Lon and Woody have been talking about, is on the right side, the asset management. The far left side shows asset servicing, which is our global custodian area of State Street, which is the largest portion and also utilized by Michigan on both the DB and the DC side. So my goal is to just come on and say hello, thank you, and then turn it over to Dave Ireland. Dave is our global head of defined contribution at SSGA, and he has a large team working with plan sponsors globally. So it provides a unique view, not just the U.S. plans, but the global plans from an investment and participant communication perspective. So we offer a holistic approach, and I'm going to turn it over to Dave now, and Lori, ask you to turn to page 6 for Dave to introduce the team and discuss the target date funds.
Great. Thanks, Mary, and thank you all for the time and the opportunity. I think I'd be remiss if I didn't echo.
This meeting is being recorded and/or transcribed.
This matter, and this what we're living through right now. I think it just makes it even more acute for me personally. Think about Michigan as a client. You're one of our largest defined contribution clients, but you're also one of our longest standing defined contribution clients. I love seeing the slides dating back to 1997. That's when we started working with the state. So over 2 decades of partnership, and we very much thank you for the business, thank you for the partnership, thank you for the trust that you put into instill in us. It's certainly not lost in us. I look at Anthony's slide of impacting 1 in 9 Michigan families. That hits home in terms of what we're all doing here today. So
this
thank you for
conference
that.
is being recorded. Only the main conference
agenda,
is
we'll
recorded.
kind of move through pretty quickly, so I do want to make sure that we get into the target date funds and give you a little bit more detail and color on the strategies. But for any of the board that's not familiar with State Street, I want to just spend a couple minutes on who we are as a strategic partner. So looking at slide 6, starting from a very high level perspective, we've been managing DC assets for close to 40 years. We're the second largest non-record keeping affiliated manager in the world with over $500 billion in assets. Target date history going back to the mid-90s. So certainly I think the size and the scale and the credibility to be a trusted partner for you. But I think what's actually even more kind of important and differentiated is the fact that we're not a retail manager. We specialize in working with institutional quality plans like yourselves. And what does that mean? Well, I look at the composition of our business and the plan sizes that we work with. It's a median size of over $3 billion. So it's a different level of partnership and conversation. The underlying investments that you are invested in are all institutional collectives versus institutional mutual funds. That offers us the ability and your participants as the end investors better tax treatment, lower transaction costs, lower cost structures. So it's very much from a product standpoint an institutional quality product. And if we flip to the next slide, page 7, we also take a more of a partnership view in terms of building out our DC business. So Laura, if we could, thank you. So looking at kind of our DC business, while we do focus on the investments, there are also other areas, namely participant engagement, where we're working with Anthony and Voya and other stakeholders. We've got folks in Washington from a public policy standpoint. So Woody talked about the Secure Act and some of the very important policy legislation that's being pushed through. We've been actively involved in advocating on behalf of your participants for those actions. Working with Senators Portman, Richie Neal from Massachusetts. So very active across a number of different facets within the business. Maybe drilling, if we go to the next slide, please. Maybe drilling into target date funds specifically, I'd focus you on the left side of the slide, and this is just the growth that we've seen within target date funds as a function of our business. And it's a good parallel to what you've experienced. As the default, your investment captures more asset flow. We're sharing in that together. I look back at 2015, we were managing roughly $30 billion in target date assets. The chart that shows as of Q2 19, over 90. I just saw the numbers as earlier this week. just broke $110 billion in assets. So it's a major focus for us from a business standpoint, and we're capturing a lot of that industry growth. Now, I think that the nice thing about that is that as we grow the business, the comment was made that Woody is very tuned into fees and the economics. As the relationship has evolved for us, I go back to 2008 when we started the relationship. The target date fees were 13 basis points. Today they're 7 basis points total expense ratio. So as we're growing the segment as a component of our business, we're working hard not only to enhance and build more diversification into the portfolio, but also to pass some of that scale and the economies of scale back on for you as the client and the participants. And maybe just to close out before I hand it over to Brendan in terms of why are we seeing this growth? And one, it's the comments that Woody made with regards to the default, but you can also see on the right side of the slide the flow, the industry flow, has predominantly and increasingly been going into index-based solutions. Where Michigan was an early pioneer of selecting an index-based target date funds, we're seeing more and more large plan sponsors making that shift from active to an index-based, focused on fees, focused on transparency within that default investment. And then just flipping to page 10, the other reason, simply just in terms of why we're experiencing growth, and this is target date just as an asset class in general, I point back to all of Woody's comments from a behavioral standpoint. Target date funds do a great job of correcting a number of the behavioral mistakes that we see with participants. I love to say that they flip inertia on its head, right? They're a default investment. They're automatically diversified. They automatically adjust to professionally managed. And what you can see on the right-hand side of this chart is they frankly provide better outcomes for your participants. In many cases, they're providing better median returns, better average returns. But what really hits home with me on this slide is that they're chopping off the tail. They're taking out the extremes. They're aligning your participants based on their age date with an appropriate asset allocation strategy. So move through that kind of quickly. I'm trying to be sensitive of time, but I'll pause to see if there are any questions, and if there aren't, I'll hand it over to my colleague Brendan Curran to talk about some of the differentiators of the State Street product that you're invested in.
Thanks, David.
Cool. Thanks, Dave. Thanks, Woody. Appreciate that I'm last in Boston parlance because that's where I'm from. I will move wicked fast here and try and leave time for a couple questions at the end. If we move ahead just one slide, just want to start. So as Dave mentioned, what are the key attributes? What do you really need to know in terms of our target retirement funds? Well, foundationally, they're what's known as passive or index-based target date funds. So they employ strategic asset allocation, long-term investment views in terms of how we mix stocks and bonds together, implemented exclusively through underlying index or passive strategies, and the product is reviewed annually. So it's a pretty steady state. It moves slowly, it moves strategically, but the benefits it affords is it's a low-cost product, it's a transparent product, and it's delivered really strong, really compelling long-term risk-adjusted returns relative to other passive managers, but also relative to those managers that might include active management. Now, where we're differentiated versus peers is captured in the value add column, and I specifically focus on that first bullet of sub-asset class management. As Dave and Woody mentioned, right, at the core of target date funds, it's this belief that asset allocation should evolve over time as participants' objectives time, slowly becoming more conservative, moving out of a stock-heavy portfolio into a more bond-heavy portfolio. Where we look to extend that rationale and that belief is through greater diversification and greater sub-asset class management. So looking to manage risk and evolve the asset allocation within stocks and within bonds. So for the sake of time, Janet, if we could jump ahead 2 slides to slide 13. I want to just paint the picture. Perfect. Thanks, Janet. So this is our glide path. This is how we mix various asset classes together as Michigan participants move towards retirement. As I mentioned, we know their objectives change over time, and so you can see from a stock bond perspective, which is represented by the more orange shading is representative of stock or growth assets. The blues are more bond fixed income assets. You see this steady reduction moving out of stocks and into bonds as the focus moves from wealth accumulation for those youngest participants to wealth preservation into retirement. Importantly, though, by employing greater diversification, we think we're further improving participant outcomes. Within equities, we employ a strategic overweight to U.S. small and mid-cap stocks and a relatively larger allocation to non-U.S. stocks for these individuals with 40-plus years to retirement, because we believe long-term, those two segments of the stock market, based on our capital market expectations, will deliver higher returns than U.S. large-cap stocks. And so we're trying to push down on that lever, that growth lever, a little bit more on in a strategic basis by overweighting these segments. Within fixed income, we're utilizing a 10% allocation to long government bonds at the starting point. That's for diversification. That's that ultimate shock absorber. The example that we used to cite was 2008, which for some folks is starting to feel like a long time ago. And unfortunately, in many respects, now we can look to just the first quarter of this year, where equities were down by double digits. Long government bonds were up over 20% and up 16% on a one-year basis as of September 30th. Now, as your employees, your participants move towards retirement, we de-risk the portfolio moving out of stocks, increasing the exposure to bonds, but at the same time reduce the risk profile of the stock allocation by shifting to an underweight of U.S. small and mid-cap equities and reducing, in relative terms, our allocation to non-U.S. stocks. Within fixed income, we're reducing risk and increasing diversification by moving to shorter duration indices, like a 1 to 3 government credit bond fund and a 1 to 10 TIPS fund. Lastly, and I haven't touched on this as much, we also believe it's critically important to protect the purchasing power of participants in retirement. And so we have a dedicated allocation to what we consider to be inflation hedging assets. And this is particularly relevant in those years after retirement, where we have an allocation to 1 to 10 TIPS and more modest allocations to REITs and commodities. So again, it's strategic asset allocation, full index implementation, but trying to be more thoughtful in terms of employing greater diversification and greater sub-asset class risk management. So I would sort of consider that all to be fancy talk without pointing towards what the results have been and what sort of value have we delivered back to your participants. And so if we move ahead 2 slides, Janet, to slide 15, and I promise I'll stop talking after we cover this slide quickly. So this slide has a ton of numbers on it, but basically what we're looking at are peer ranking. So how did our target date funds returns and risk rank relative to the Morningstar target date universe? So this is hundreds of other target date fund solutions. We've, as Dave mentioned, we've been managing commingled target date funds since 2005. So our since inception numbers captured on the right-hand side have seen a lot of different market conditions. I mean, again, you think about the 2008, you think about the first quarter of this year, you think about the strong equity market that we've realized between that, the periods of Brexit volatility. We've seen a lot in the 15 years that we've been managing this strategy. And we're proud of the results and the stability of the solution. And so that second column from the right, since inception percentile ranking, that's our return ranking since inception. So over 15 years. And a score of 1 means you're the strongest manager over that time period. And so focusing on that bottom number 8, what that means is on average, the State Street Target Retirement Funds have outperformed 92% of peer products over this 15-year time horizon. So really strong peer relative returns. And importantly, that final column to the right is the risk ranking. It's ranked with the volatility of the product. Because we all know one of the ways to do better over the long term would have been to take more equity risk, but that'll show up in a pretty poor volatility ranking. Now the volatility ranking here is read in reverse, so a score of 100 means you're the lowest risk, least volatile manager. And so importantly, we sit just outside of top quartile, so ranked in the 26th percentile from a volatility or risk perspective since inception. So really strong risk-adjusted returns, and even looking over the 1, the 3, the 5, the 10, again, really proud of the results that we've been able to deliver to your participants And it's a function of the strategic index-based approach that we've taken that employs greater diversification and greater sub-asset class management to deliver better outcomes to your participants. So I know we're 7 over. I said I'd go with it fast. I don't know if that qualifies, but I will pause here to see what questions or comments you might have for me, Dave, or Mary.
And Brendan, I would just add, I don't think it doesn't change the results here, but just so there isn't any confusion, that we're showing you this the 12 basis point total expense ratio share class, so it's a bit more of an expensive share class than what Michigan has invested in at the 7.
Thank you, and appreciate the expedited covering of that material. It was very interesting, and certainly always glad to see where the rubber hits the road and, kind of what the work that we're doing here. So thank you for that.